Welcome back to Talk Tickers. Today we are unpacking a beauty giant that just decided to look the macro gloom in the face and put on a fresh coat of mascara.
Yeah, I like that.
We are looking at e.l.f. Beauty, ticker symbol e.l.f. And if you're listening to this, you probably already saw the tape, but wow, we have to set the scene because it was absolutely wild.
It was certainly a statement quarter. I'd argue it was one of the loudest statements we've seen in the consumer discretionary sector in a long time.
Statement is putting it lightly. So let's paint the picture. The stock closes regular trading around $76, down just a fraction.
Right. Very quiet.
Yeah, it felt like a typical nervous pre-earnings holding pattern. Everyone's holding their breath. And then the print hits. The after-hours tape went absolutely parabolic.
It really did.
We saw a surge of, 12 to 16% almost immediately, pushing implied pricing up toward $95, maybe even $98.
Which is a massive move for a company of this size. I mean, when you see a double-digit pop like that on an earnings release, it tells you the market was expecting a single polite knock on the door, and e.l.f. just kicked it off its hinges.
Exactly. The vibe here is not cautious optimism. It is a full-blown victory lap.
Mm-hmm.
So today we're breaking down this massive beat, the road to riches. And yes, we are talking about the Haley Bieber acquisition because that is really showing its teeth now. And we'll get into the nuance of the, the organic growth debate and that guidance raise. But first, let's just look at the scoreboard.
Okay, let's start with the top line. Total revenue came in at $489.5 million.
489.5.
Yeah, so that's up 38% year over year. To put that in perspective, the consensus on the street, what the analysts thought would happen, was looking for about $460 million.
So that's a beat by nearly $30 million.
It is a huge beat.
That is a significant chunk of change to find in the couch cushions. Usually a beat is a couple of million here or there.
Sure.
30 million is a different animal.
It is, but where the jaws really dropped was the bottom line. Adjusted EPS earnings per share hit $1.24.
Okay, and remind us, what were people expecting?
72 cents.
70. Wait, you're saying they beat their earnings per share estimate by 52 cents?
52 cents.
That's not a beat, that's a demolition. I mean, how do you even miss by that much on the positive side?
This brings us to a concept we love, operating leverage. Basically, their sales just grew so much faster than their costs.
Right.
Once you cover your fixed costs, your rent, your salaries, your factory lights, every extra dollar of sales flows almost purely to profit.
Okay.
e.l.f. is scaling so efficiently that their profitability is exploding faster than their revenue. Adjusted EBITDA is up 79% year over year to $123 million.
79% EBITDA growth against 38% revenue growth. Wow. That is the definition of operating leverage right there.
It is.
And perhaps most impressively, despite all the noise we hear about tariffs and supply chains, their gross margins held strong at 71%.
Which is an elite number. And because of this efficiency, they didn't just drop the mic there, they raised the roof for the full year. Fiscal 2026 is looking significantly better than they previously thought.
Right, the raise part of the beat and raise.
Exactly. They lifted the net sales guidance to a range of $1.6 to $1.12 billion.
Okay.
And they raised the adjusted EPS guidance to between $3.05 and $3.10.
So what does this all mean in the grand scheme of things? I mean, this puts e.l.f. in what management called a rarefied group.
Yeah, they mentioned that.
They noted they are one of only 6 consumer companies out of 546 track-to-grow sales for 28 consecutive quarters, while averaging at least 20% growth. That is consistency that you just don't see in retail. Not anymore.
It's incredibly rare. Most trends burn out. This suggests that their model isn't just a trend, it's a structural shift in how beauty is consumed. But we have to address the elephant, or perhaps the glazed donut, in the room.
We have to talk about the shiny new toy. This was the quarter where the acquisition of Rhode, Haley Bieber's brand, really showed us why they bought it. When they announced this deal, there were some skeptics. Was it just a celebrity vanity project? But looking at this quarter,
that skepticism is evaporating fast. This is where the numbers get fascinating. Rhode contributed $128 million to sales in Q3 alone.
Wait, just in one quarter? $128 million?
In one quarter, yeah. That accounted for roughly 36 percentage points of the total growth we saw.
That is absurd. So basically, if you take Rhode out of the equation, this is a very different conversation.
It would have been a much quieter call, yes, but you can't take it out because e.l.f. owns it now. And the performance metrics for Rhode are staggering. It achieved the #1 brand ranking at Sephora North America.
#1?
And the Sephora UK launch. It broke records. Management said it was 5 times bigger than the previous record holder for a launch in that region.
5 times bigger. Okay. We need to dig into the why here. Is this just Haley Bieber's face on a poster?
Right.
Or is there something, mechanical happening in the strategy?
It's a mix of celebrity, yes, but it's also what I call the drop culture model applied to lip balm. They aren't just putting product on a shelf and hoping you see it.
Right.
They are engineering scarcity. When a lip tint drops, it's an event. It creates a frenzy that legacy brands, which rely on simply being available at the drugstore, have forgotten how to manufacture.
It's the streetwear model. It's supreme, but for skincare.
Precisely.
Yeah.
And the execution is just flawless. Management now expects Rhode to bring in roughly $260 to $265 million for the full fiscal year.
Okay, and what was the old number?
Previously, they thought it would be $200 million. So that implies the brand is growing around 70% year over year on an annualized basis.
So this wasn't just a bolt-on acquisition. It's basically a rocket engine they strapped to the side of the ship.
Exactly. And international demand is a huge part of this story. They noted that 74% of Rhode's social followers are outside the U.S.
74%.
But currently, international sales are only about 20% of their direct-to-consumer mix. That gap represents massive pent-up demand.
That is a lot of runway. That is millions of people just waiting to give you money. But let's pivot back to the launch pad, the mothership, the core e.l.f. business. Because we keep hearing that the consumer is stretched, inflation is biting, people aren't spending, credit card debt is up. Why does e.l.f. keep winning when the consumer is hurting?
It's the trade-down thesis, but with a twist. Usually, trading down feels like a sacrifice.
Yeah, you buy the generic cereal and it tastes a little worse.
Exactly. e.l.f. has managed to make trading down feel like trading up, or at least trading smart. It's the price gap. The average price for an e.l.f. product is $7.50.
$7.50. That is literally the price of a fancy coffee.
Right. Compare that to legacy mass brands. Think the stuff you've seen in drugstores for decades. Their average is $9.50.
Okay.
And prestige brands, the stuff in the fancy department stores, the average is around $30.
So e.l.f. is significantly cheaper than even the cheap stuff and a fraction of the price of the luxury stuff.
Precisely. And they highlighted a statistic that really matters in this economy. 75% of their portfolio is still priced at $10 or less, even after they implemented some price increases.
And they are unapologetic about the dupe culture. They see a prestige product and they say, we can do that for $10.
They call it innovation, but yes, the market often calls it duping. They launched a slip stick for $10, which is competing directly with a prestige competitor selling a very similar item for $48.
$48 versus $10. I don't care how loyal you are to a brand, that is a hard argument to win if you're the $48 guy, especially if the quality is comparable.
And they also mentioned a soft glam satin concealer at $5 versus a prestige item at $32.
$5 in 2026. That feels like 1990s pricing. That is wild.
It is, and it's driving market share. They gained 130 basis points of market share in the quarter. In the U.S., the brand grew consumption by 8%.
8%.
Which is 2 times the rate of the overall category.
But hold on. Here is where it gets really interesting, where we need to put our skeptic hats on.
Okay.
If you look closely at the numbers, there is a stat that the bears, the pessimists, are going to try to latch onto. In fact, if you just scan the headlines, you might miss it.
They're talking about the organic growth?
Right. The headline revenue growth was 38%. Amazing.
Yeah.
But if you strip out Rhode, organic net sales were only up about 2%.
That is the gotcha metric. If you just look at the spreadsheet, it looks like the core business stalled out. 2% growth is barely inflation. So is the core business dying?
That is the question. Why is there such a massive gap between the headline and the organic number?
It's largely about what they call pipeline cycling. This gets a little technical, but it's critical to understand.
Okay, break it down.
Last year at this time, they were in the middle of a massive shelf space expansion. They were launching into $11,000 general stores and significantly expanding their space at Target.
Okay, so last year they were shipping Huge fill-the-shelf orders.
Exactly. Let's use a pantry analogy. Imagine last year, Target decided to stock a brand new pantry with e.l.f. pasta. To fill that pantry, they had to buy 500 boxes all at once.
Right, a huge sales spike for e.l.f.
A massive order. Now, fast forward to this year. The pantry is already full. Target only needs to buy one box to replace the one box a customer bought.
Ah, I see. So last year was the fill. This year is the refill.
Exactly. The sales to Target, the shipments, look lower because they aren't buying the initial 500 boxes. That creates about a 4% headwind because they aren't shipping those initial massive orders.
So it's a tough comparison against last year's one-time event. It's not that people stopped buying the product. It's that the store didn't need to build the pantry from scratch again.
Correct. And that's why ManageMe argues you shouldn't confuse shipments with consumption.
Okay.
Global consumption people actually scanning the item at the register is up 6%. They believe consumption is the true health indicator, and eventually shipments will have to catch up to match that demand.
So the bear case is sales to stores slowed down. And the bull case is people are still buying it. We just haven't shipped as much to the warehouses.
That's the crux of it. They also cited some international softness, specifically in the UK and Germany. But the main story is this inventory timing. If consumption remains strong, the shipments will follow.
Okay, that makes sense. It's a timing mismatch, not a demand collapse. But there is one more piece to the puzzle that usually scares investors. Tariffs.
Right. The macro boogeyman.
Tariffs are currently at a 45% rate for them. Remember, earlier in the year, there were fears this could go as high as 170%.
45 is better than 170, but it's still a bite. That cuts directly into margins.
So how are they maintaining that 71% gross margin we talked about earlier?
Pricing power. They implemented a $1 price increase globally to offset this. And this is the key. They noted that the volume impact was minimal, only a single-digit decline.
Let's define what that means. We call that inelastic demand. They raised the price and customers didn't run away.
Exactly, because even with a dollar increase, there's still $7.50 versus $30. The value moat is wide enough to absorb the tariff costs. The consumer looks at the price tag, sees it went from $6.50 to $7.50, shrugs, and buys it anyway because the alternative is still $20 more expensive.
Let's talk about how they keep that consumer attention, because their marketing machine is, well, it's loud, it's weird, and it seems to work.
It is incredibly efficient. We call it marketing alpha. They are getting returns on ad spend that most companies dream of.
They mentioned the Liquid Death collab, the corpse paint collection.
The sequel collection, actually.
Right, the sequel. They said the second drop sold out in 19 minutes.
19 minutes. That is hype. That is streetwear level hype for makeup.
And they're going back to the big game?
The Super Bowl, yes. Streaming on Peacock and Univision. They estimate a reach of nearly 300 million people.
Wow.
And they also mentioned Roblox. 25 million attempts on their Liquid Death obstacle course.
I still can't believe Liquid Death obstacle course is a phrase we're using in a serious earnings analysis. But here we are. It shows they are meeting the consumer, especially Gen Z and Gen Alpha, exactly where they are.
It does. It sounds ridiculous to a traditional investor, but to a 14-year-old, it's their world. And that 14-year-old is driving the consumption growth.
Right.
But behind all the hype and the obstacle courses, there is financial discipline. This isn't a company burning cash just to be cool.
What's the balance sheet looking like? Can they afford all this?
Very healthy. They have about $197 million in cash on hand. Net debt is less than 2 times EBITDA, even after buying Rhode.
Yep.
And they are putting their money where their mouth is regarding the stock price.
You mean buybacks?
Yes. They repurchased $50 million of stock in the quarter. Management explicitly cited a disconnect in valuation. They basically said, the market has beaten our stock down too much, so we're buying it.
That is a strong signal. When a growth company, a company that usually wants to save cash to expand, buys back stock, it tells you they think their growth is completely misunderstood by the market.
It connects back to the bigger picture. You have a company growing the top line at 38%, holding margins over 70%, and buying back stock.
It's a rare combination.
It is. Usually you get high growth and low profit, or low growth and high profit. e.l.f. is managing to do both.
So, summarizing the Talk Ticker's takeaway here, it's a clean, beaten raise. Rhode is outperforming expectations faster than anticipated. It's basically a second growth engine now. The core business is resilient due to that $7.50 price point. despite some noisy organic growth numbers caused by the pantry loading effect we discussed.
And the market reaction reflects that. The after-hours move of 12 to 16% tells you that investors are willing to look past the organic shipment noise and focus on the consumption growth and the Rhode explosion.
Yeah.
They are winning on volume and value while the rest of the industry struggles with elasticity.
It feels like they are uniquely positioned. When times are tough, people buy e.l.f. because it's cheap. When times are good, people buy e.l.f. because it's cool. It's a win-win.
It is a very sturdy position to be in. They
Yeah.
have built a brand that transcends the economic cycle.
All right, you know what time it is. We've looked at the numbers, we've analyzed the strategy, we've debated the bear case. Now it's time for our favorite segment.
The part where we get a little reckless.
Exactly. This is not financial advice segment. We are just two voices in your headphones analyzing the data. We are not financial advisors. Do not do what we say.
Yeah.
Do your own diligence.
Please.
But if we were pitching a wild trade idea to an investment committee right now, based on this earnings call, what is the play?
I think we have to look at the vanity arbitrage pair trade.
Vanity arbitrage. I love the sound of that. Break it down for us.
Okay. The long side is obvious. You go long e.l.f. beauty, e.l.f. But here's the short side. You short a basket of old world prestige beauty.
Ah.
The legacy brands that are still trying to sell concealer for $32 and lipstick for $48.
So we are shorting brand ego and going long chemical reality.
Precisely. We are entering what I call the dupe economy. The consumer, largely thanks to TikTok and social media, has realized that the chemical composition of the $48 lipstick and the $10 slipstick are 95% identical.
It's an information asymmetry arbitrage. The consumer knows too much now. They know the goop in the tube is the same goop. They aren't paying for the logo anymore.
Exactly. And the catalyst is that Lip Crypt Vault selling out in 19 minutes. That proves that brand heat has migrated. It used to be that the heritage brands had the prestige.
Right.
Now the heat is with the disruptors. We are betting that Gen Z doesn't care about your 100-year history. They care that Haley Bieber uses it, or that it looks cool on Roblox, and crucially, that it costs $5 so they can buy 5 different colors.
That's the key psychological shift. For the price of one prestige lipstick, I can get a full face of e.l.f. makeup. That is a trade on consumer psychology that feels very sticky. Once you realize you can look just as good for 20% of the cost, you don't go back.
And as long as inflation remains a memory in people's minds, that value proposition is undefeated. Short the ego, long the value.
The vanity arbitrage.
Yeah.
Long the $5 concealer, short the $30 ego. I like, again, totally not financial advice, just an outrageous idea to chew on.
But a plausible one.
Very plausible. That is all we have for today on Talk Tickers.
Yes.
e.l.f. takes a victory lap, Haley Bieber is printing money, and the dupes are winning. We will see you next quarter to see if they can make it 29 quarters in a row.
Thanks for listening.